You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Deep Dive. You've brought us a pretty dense briefing this week. It really covers the whole map of global risk, everything from tiny currency fluctuations right up to, well, military airspace warnings. It feels like we need to connect some dots here.
That's absolutely the plan. We're aiming to synthesize really three big interconnected themes. First up, the latest on inflation, specifically what the Fed seems laser focused on right now.
Okay.
Second, this sudden, really quite dramatic shift in global trade policy. We're calling it the tariff tsunami internally.
Tariff tsunami, I like it.
And finally, we'll track those geopolitical flashpoints that feel most, elevated. Think NATO's perimeter, the Middle East diplomacy, chessboard, that kind of thing.
All right, let's dive right in. Makes sense to start with the money flow, the monetary signals. I mean, it seems like forever now the story's been the Fed and inflation.
Yeah.
And the spotlight seems to have swung hard towards their favorite gauge, the PCE.
Precisely. And just for listeners, PCE, that's personal consumption expenditures. It's the one the Fed prefers because it tries to account for how people actually swap things out when prices change, like buying chicken instead of beef.
Right, the substitution effect.
Exactly. And Chair Powell gave us some guidance, some numbers this week. He's seeing the August headline PCE year over year coming in around 2.7%.
Okay, 2.7% headline. But the one causing more, maybe, anxiety is core PCE, the one without food and energy.
That's the one, expected at 2.9%. And the interesting bit here, the so what, is that difference. When core is running hotter than headline, well, it suggests those really sticky parts of inflation services, rent, wages, they're still, dug in.
Stuff that's harder for the Fed to tackle just by hiking rates.
Exactly right. Makes that inflation fight much trickier, potentially longer.
And we're seeing the immediate market reaction mainly in currencies, right?
Yeah.
The dollar seems to be, catching its breath a bit after that big run-up.
It is taking a breather, yeah. It's tracking these inflation numbers, obviously, and all the tariff news we'll get into. But look at the technicals. You can sort of see where the lines are being drawn.
Like with the euro.
Yeah, the euro found some footing just under 1.1650. Now it's kind of nudging back towards its 50-day moving average. That's at 1.1679.
Okay, for folks maybe not staring at FX charts all day, hitting that 50-day average, what does that actually signal?
Well, it's a key level, technically and psychologically. It's often where momentum can shift. So traders use it to gauge, the medium-term trend. If the euro is trying to get back above it, suggests a little confidence might be returning, but it's still pretty fragile.
And sterling?
Sterling's still sort of stuck in a range around 1.3350. Meanwhile, dollar-yen, that stayed pretty firm. It almost touched 150, which is a huge psychological number.
Wow, yeah. And looking broader, globally, this sticky inflation narrative isn't just a U.S. thing. We saw the Tokyo CPI print come in.
Right, 2.5% year over year. Now, that was actually a touch softer than maybe some expected, but the analysis we're seeing suggests it still points to those, quote, stickier underlying inflation dynamics.
So even if the big headline pressures ease off.
The domestic stuff, rents, services, again, they're still running quite hot. It shows inflation as kind of a synchronized issue globally, not just a Fed problem.
Got it. And then China throws another curveball into the FX mix. The PBoC, their central bank, set the yuan midpoint stronger than expected.
Significantly stronger. They set USDCNY at 7.1152. The market consensus was way up at 7.1439.
So they deliberately made their currency more expensive. Why?
It's a signal, a political one, really. It shows the People's Bank is actively pushing back against the downward pressure on the yuan, pressure that's coming from, escalating trade tensions with the U.S. It's them saying, we still have control here, even amidst a tariff battle.
Okay, speaking of trade friction, geopolitical heat. That leads us right into commodities. That's often where you see risk priced in first. Crude oil's looking a bit firmer.
Modestly firmer, yeah. And it ties directly to those risk signals picking up. We're watching really two main things. First, Russia's partial diesel export ban, and they extended the gasoline export ban, too. Any change there hits global prices immediately.
Right.
And second, just the general sort of drumbeat of NATO-related headlines, that injects a definite risk premium into energy.
Makes sense. Meanwhile, gold's kind of paused after that big run towards, what was it, $3,800 an ounce?
Yeah, it's holding back a bit, waiting for that PCE data we talked about. Nobody wants to chase it right now.
And you see similar restraint in copper.
Exactly. Copper actually gave back some of its recent gains. There was that spike driven by a genuine supply issue, the Freeport disruption. But even that couldn't hold. The tariff headlines, the general caution before the U.S. data, it's keeping a lid on things for now.
Okay, let's tackle the elephant in the room then. The tariff tsunami. Washington just unleashed, one of the most sweeping sets of trade measures we've seen this year. This isn't just tweaking things, is it?
No, not at all. This feels like a fundamental pivot. They're using tariffs explicitly as an industrial policy tool now. It's about forcing production changes, not just collecting duties.
Historic, really. Let's break down the specifics because they're pretty stark, starting with pharma.
Right. Effective October 1st, 2025. So there's a timeline. A massive, almost unbelievable 100% tariff on branded or patented pharmaceutical products.
100%. That basically blocks imports, but there's an out, right? The caveat.
The only out is if the company builds its manufacturing plant in America.
So build here or pay double?
Pretty much. The U.S. is effectively using tariffs like, a giant state-backed venture capital fund forcing billions into domestic manufacturing. It's explicit industrial policy way beyond just trade defense. And it doesn't stop at pharma. It hits everyday consumer goods, heavy industry.
Yeah, the list goes on. We've got a 50% tariff on things like kitchen cabinets, bathroom vanities, then 30% on upholstered furniture, and 25% on all heavy trucks made outside the U.S. And on top of the direct tariffs, there's pressure on supply chains, like semiconductors. This 1.1 ratio idea.
Right. This proposed plan basically says companies need to maintain, over time, a 1-to-1 ratio of domestic versus foreign production. If they don't hit that balance, tariffs.
But hang on, a 1-to-1 ratio. For industries built on global specialization, isn't that, almost economically impossible for some? What are the sources saying about the immediate fallout?
That's exactly the tension, right? The sources absolutely acknowledge these policies will cause near-term disruption, likely price increases for consumers, But the calculation in D.C. seems to have shifted.
How so?
National security, supply chain resilience, those concerns now apparently outweigh the short-term economic pain, and that's hammered home by this new national security probe they launched.
The Section 232 probe. We should probably explain that it's a pretty heavy tool, rarely used.
It absolutely is. Section 232 investigations are supposed to be reserved for imports that threaten national defense. So by opening one focused specifically on robotics, machinery, and medical devices.
They're essentially classifying robots and factory machines as strategic assets, like tanks or something.
Effectively, yes. It makes it crystal clear. Economic policy and national security thinking are completely merged now. And
this isn't just a U.S. phenomenon. The EU is moving in a similar direction.
That's crucial context. Yes, the EU is also prepping tariffs, looks like 25% to 50%, on Chinese steel and related products. It signals a kind of coordinated Western pushback, trying to link market access to domestic production.
Interesting. But Japan getting reassurance.
They did. Japan was apparently assured that U.S. tariffs on their chips and pharma won't be higher than those on other countries, so it suggests the U.S. is differentiating, maybe, between allies and strategic competitors here.
Okay, let's shift gears slightly to tech, control, and specifically the signals around the TikTok deal. The president signed the executive order, said he had good talks with President Xi, claimed China is fully on board.
Yeah, that statement, fully on board, definitely requires a closer look. The sources we have dig into the deal specifics. American investors taking over, Oracle playing a, quote, very big part, a valuation around $14 billion.
But the absolute key point, the thing that supposedly fixes the security risk, is that Americans will control the algorithm.
That's the headline win the U.S. is claiming.
But is the source material hinting the administration might be, let's say, overly optimistic with China's fully on board? Or did she really just fold on controlling a major tech platform's core algorithm?
Well, the sources certainly suggest some skepticism is warranted. The public focus is all on controlling the algorithm. That's the stated victory. The White House is framing China's apparent compliance as a diplomatic win.
Right.
But you have to contrast that, high-level political messaging with what was happening simultaneously behind the scenes.
You mean the other meeting, the low-key one at Treasury?
Exactly. That Chinese delegation meeting with U.S. Treasury folks, very specifically staff-level technical discussions about the economy. And both sides went out of their way to confirm this was not a negotiation, and it did not cover TikTok.
So you have the big public announcement about TikTok control in one room.
And the quiet, technical, non-negotiating groundwork happening in another. It really highlights the sort of multi-layered, sometimes contradictory approach to the whole U.S.-China relationship right now.
Okay. Let's wrap up by looking at these elevated global flashpoints. Maybe group them under the idea of gray zone conflict escalating. The tension around NATO's perimeter feels particularly high.
It does seem acutely high, yes. The situation in European airspace is, frankly, deeply concerning. That incident in Denmark, unidentified drones over 4 different airports, actually closing one for a bit.
Yeah, that's worrying.
It's classic gray zone activity. Unattributed, probing, designed to test responses, just short of an outright attack. And there were reports of events near military sites, too. Authorities there even mentioned possibly raising the national emergency level.
And the language is getting sharper, too. These warnings about shooting down jets.
Significantly sharper. We heard about private warnings from European officials to Russia, basically saying, we are prepared to shoot down jets. And then that was backed up by a public warning from the Dutch Prime Minister. That's a huge escalation from standard airspace violation protocols.
Wow. And this physical risk? It's mirrored near Ukraine, too, especially around nuclear sites.
Disturbingly so. The IAEA, the nuclear watchdog, reported a drone was shot down and actually detonated only about 800 meters from the perimeter fence of Ukraine's South nuclear power plant.
800 meters. That's
Yeah.
incredibly close.
Uncomfortably close, yeah. Their team saw something like 22 drones in the area, heard gunfire, explosions. It's a clear, elevated threat to absolutely critical infrastructure.
Okay, switching focus to Middle East diplomacy. It seems like the U.S. is trying to manage multiple fires at once, de-escalation attempts alongside drawing firm lines.
That's a good way to put it. We're apparently expecting a major announcement on Syria. The president mentioned good talks with Israel's PM about Gaza, hinting a hostage deal could happen soon. Those sound like efforts to lower the temperature.
But at the same time,
At the same time, a very clear, very firm statement. The U.S. will not allow an Israeli annexation of the West Bank. That's drawing a hard diplomatic boundary.
and finally, connecting back to where we started with Russia and energy, the U.S. is trying to bring regional partners into play.
Specifically Turkey. The U.S. is now asking Turkey to halt its purchases of Russian oil.
Why is that significant now?
Because the implication is clear. Washington believes Ankara could have real influence over Moscow's decisions. It's calculus. It shows the U.S. trying to use multipolar leverage, getting a NATO ally to squeeze a key Russian revenue stream, even while dealing with all this direct tension on NATO's own border.
Okay, so bringing this all together, for you, the listener, trying to make sense of this sheer volume of risk signals, what are the core takeaways? Synthesizing all this, I think 3 things stand out. First, inflation, especially that sticky core number, is still the central driver globally, even if currencies pause briefly.
Absolutely. Second, the U.S. is making a huge bet on domestic production, using these unprecedented tariffs as a direct tool of industrial policy. It fundamentally changes the game for global trade.
Right. And third, these geopolitical friction points, the gray zone stuff near NATO, the nuclear risk in Ukraine, the diplomatic lines in the Middle East, they're not just simmering, they're volatile and forcing real-time adjustments. It feels like economics and national security are now just one thing.
They've completely merged. I mean, the moment the U.S. uses a Section 232 probe to classify factory machinery as a national security asset, you know that supply chains aren't just about economics anymore. They're viewed as core to sovereignty. That connection, I think, is the most profound takeaway today. And maybe one final thought for you to consider, to mull over. Think about the relationship between that firm U.S. stance against West Bank annexation and the simultaneous push for Turkey, a key regional player, to cut off Russian oil. How might those seemingly separate actions, one about territory and regional stability, the other about energy markets and global leverage, actually be part of a single complex calculation? How is the U.S. using different pressure points, economic and diplomatic, across continents to achieve potentially linked strategic goals? Something to think about as you navigate these very complex global signals.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.